In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, a downbeat debut. Xiaomi shares drop on its first day with escalating trade tensions and uncertainty about its valuation, leaving investors feeling skeptical. Plus, electric scooter renter Line sets itself up for global expansion with a massive new funding round and a partnership with Uber. We will speak to co-founder Toby Sun. And deal site Groupon is reportedly seeking a buyer. Would this be the best solution for the company that's trying to turn things around for years? But first to our top story. Xiaomi's debut was a day to forget, falling as much as 6% on its first day of trading in Hong Kong as an escalating trade war and uncertainty about its valuation dampened the exchange's biggest offering in 2 years. The weak opening in the midst of a China-U.S. trade war may deter Chinese tech companies seeking to raise capital this year, but it was still a highly anticipated IPO. Take a listen to what's been said on Bloomberg Television so far.
We are actually a new species. We are an internet company that can do e-commerce and hardware well at the same time. I don't think there's anything like us in the market before.
But ultimately, it's what can you do with the device? And that's a software question. That's a software story. And so I think pushing away from kind of a hardware background into a more diverse offering, I think that makes a lot of sense. And I think I commend them for doing it. I think that's strategically a good move.
We are locked up for 12 months. And even after that, I think we still, we'll hold longer because we believe the upside for this company is much higher than the current, the status.
Tencent, Alibaba, Facebook, all the great ones, when they first IPO, need time to convince the investors that it is indeed special. Xiaomi is in that category of companies.
Keep in mind, services, you've really got to be very local specific when you develop services. And I'm not sure it's necessarily that easy to just copy and paste, if you will, and put it into another country.
Joining us now to discuss, Ben Harburg, a managing partner, MSA Capital, a Beijing-based venture fund, along with Bloomberg's Mark Gurman, who covers consumer technology. Mark, what does Xiaomi still have to prove?
Well, they have a lot to prove right now. They are very localized to China and some of the more developing markets like India. They are doing very well in both India and in China, but that's just one portion of the world. There's obviously the whole trade war tension right now, and the ability for Chinese hardware makers to get their devices in the U.S. and Europe is becoming an increasingly difficult problem.
Shelley Banjo also joining us now from New York, our tech reporter who's normally based in Hong Kong. Shelley, how much of a disappointment is this?
I think it's a big disappointment just because of how much expectations were built up. I think if Xiaomi would have come to the market and as they were, it was a big accomplishment for what they've been able to do. 8 years in existence and becoming, one of the world's biggest smartphone companies. But they didn't just rest at that. Instead of saying, this is who we are and this is what we make, they said, we're actually this $100 billion company that, is an internet services business. And so that's kind of where this mismatch lies.
Ben, I just want to point out, Lei Jun, the founder of Xiaomi, is an investor in your fund. Would you be a buyer of Xiaomi today?
I am. I think it's...
At twice the price of Apple.
I am. I think it's a business that's really been underestimated and misunderstood. I think it's a company that's delivered a product, hardware that is actually a delivery device for multiple services. And in order to be a $100 billion company, I think they have to really disrupt and destroy an entire business. In this case, it's IoT. What they've done is they've made it democratized, and they've put devices in the hands of everyone, not just in China, but in multiple emerging markets. And that gives them a platform then to deliver services at a very high margin.
Mark, you cover Apple. Is this worth twice as much as Apple?
Is it worth twice as much as Apple? If you look at unit sales that Apple is selling at, it's unprecedented. But if you go back to what Ben was saying in terms of delivering the services across hundreds of millions of devices across the world, that's where the lucrative markets are. We see Apple and Google and Amazon all shifting towards a services strategy. The problem is that Xiaomi, obviously a China-based company, has so much competition in the services world. We have Tencent and everyone else trying to get a piece of the pie there. WeChat, it's a whole different world in terms of services there. And Xiaomi is not ahead of the pack in terms of that.
And you heard the company make the argument earlier that they're an entirely different new species. Are they really an entirely different new species?
There's nothing really new there. No.
Ben?
think they are. I mean, again, in the IoT space, what they're doing is you had all of these disparate makers, people like Fitbit, others. They've essentially wiped all of them out by making a product that they can sell for a tenth of the price, still at profit, but then they can integrate it into this platform. So it's really only early days in the services platform. They'll provide things like healthcare, insurance, finance, all kinds of other apps that they can plug you into once they've got you. It's really unprecedented for us as Americans, but when you buy a Xiaomi television, for instance, you're forced to watch advertisements on it. So once they're in your home, which they will be because the products are superior quality, but at half the price, you have to take their services. It's a delivery device.
Shelley, how much of this result is about being caught up in a trade war?
I think that's the line you're going to hear from a lot of people, that, oh, this was kind of bad timing, and they're not wrong. I mean, this isn't great timing for the markets. If you look at China and Hong Kong in general, both markets are down, and there's a lot of jitters about the trade war. But the thing is, Xiaomi's not even in the U.S. right now, so their business isn't actually going to be affected by anything having to do with the trade war, and so Xiaomi specific probably won't be that impacted by trade war, at least in the near future.
Mark, you've done a ton of reporting on the devices coming out later this year, including new iPhones. What is the hardware lineup that Xiaomi is going to be up against from Apple and others?
Yeah, and speaking of that, I still think there's an opportunity for a player, whether they're US-based or China-based, to come in with a very high-end premium phone at a sub-$500 price point. We've seen other Chinese phone makers do that. We've seen companies like OnePlus do that. Apple, to your question, is working on a cheaper iPhone as well, but no one has really nailed it. No one has had that combination, to Ben's point, of something that's good and cheap that people are going to buy in high volume. So Xiaomi had that opportunity, and right now in this political climate with this administration, it doesn't seem plausible that Xiaomi, Huawei is having this problem as well, ZTE, is going to be able to have that success in the U.S.
Ben, given the showing here, you're an investor in several other Chinese tech companies, Meituan, for example, another company that's planning to go public soon. Do you think this could lead some of those companies to change plans?
I don't think so. Again, I think it's tough timing. I think they were the first out the gate with a dual share structure. They had the CDR hiccup at the beginning. I think it's just a difficult position for them. Meituan, obviously a very different business, one that I think global investors understand a lot more easily because it replicates a lot of existing models under one platform. You can kind of show how all those integrate. Much more understandable than this new species, as Lei Jun describes it. We would call an Indominus Rex, something that's a combination of multiple business models under one roof. Really difficult to understand.
Shelley, Xiaomi also has the mainland China half of its listing to come. How is that going to work, and could the company recover?
That's something that remains to be seen with what's going to happen with the CDR. I mean, they really tried to push for it. They want to be part of it, but there's big disconnects between what the government wants, what regulators want, and what companies want. And so it's going to take at least 6 months for Xiaomi and the regulators to work through this. Could take a year, or it could never happen. I mean, it's still this new thing that no one has really been able to figure out. And Xiaomi was supposed to be the test case, and that didn't happen. So we'll see what happens if other tech companies, maybe more established companies like Alibaba, come forward first, and that might lay the way, pave the way for a company like Xiaomi to come after that.
The speculation, Mark, about Xiaomi's entrance or attempt to enter into the U.S. market with phones has been going on for years. Do you think Xiaomi could be the one to offer that lower-priced, high-end handset? I mean, what are the chances that they would be the one?
It could and should be them, but the problem is this political climate is really not going to allow it. There's been this big emergence of the U.S. not wanting Chinese-based technology companies putting their devices for sale in the U.S.
ZTE, case in point.
Right, all their equipment, and et cetera, et cetera. So it's going to be difficult right now. It'll be seen if that's going to be difficult for the next 4 years, 7 years, or even longer, depending on what the next administration is, or if this administration changes their stance on these Chinese companies.
All right, Mark Gurman at Bloomberg Tech, as well as Shelley Banjo and Ben Harburg of MSA Capital. Thank you all. Well, there's a new sign. The long-struggling recorded music industry is continuing its comeback. China's Tencent plans to spin off its online music business and list shares in the United States. The move will let American investors bet on the Chinese market for music streaming. Those services have brought new life to an industry that has been plagued by piracy. For the second year in a row, consumer spending on music has seen double-digit growth. Last year, U.S. music lovers spent over $8.7 billion, up 17% from 2016. Coming up, charging up for an electric scooter Turf 4. We'll speak to the Lime co-founder, Toby Sun, next. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. The electric scooter rental startup Lime has announced a $335 million funding round, which includes a partnership with none other than Uber. Details of the alliance are still being finalized, but Uber says it will promote Lime in its mobile app. The financing, led by Alphabet's venture arm GV, pushes Lime's valuation to $1.1 billion. But will it give the company an edge in the brewing two-wheel turf war? Joining us now to discuss, Lime CEO and co-founder Toby Sun. Toby, thank you so much for joining us.
Thanks for having me.
So this partnership with Uber, how will it work?
So Uber will be our strategic partner, right? So they will start from investing, and then on top of that, we'll be also doing co-branding, and also we'll make our scooters available on their app.
So are we going to see the Uber sign on Lime
Yeah,
scooters?
we're still figuring out the details, but possible. Yep.
So how much business will this actually drive for you? New business?
Yeah, it's a good question. We still don't know, but so that's the purpose of this partnership, right? So this is a new space. We want to figure things out, and thrilled to have Uber as our partner, and then we'll test it out and then see how it works.
A $1.1 billion valuation is significant. What are the numbers to back that up?
So this is a massive market, right? Transportation, mobility, and first and last mile transportation has been a challenge for a lot of the high density cities, right? So we have seen a lot of people, started to use that for fun, but now a lot of people are using that for commute to embed that into their daily life. And if you look at 2013, when Uber first raised their 3.5 billion round, right? So people feel that's a little bit surprised.
Also from GV.
Yeah, also from GV. And then now if you look at Uber, it's already over 60 billion, right? So I think the most important thing is we're creating a movement that changes people's behavior. If you think of that way, I think this is not a crazy evaluation.
How many rides a day?
So we can't disclose that, but I would say we're growing really, really fast, and then we're serving we've already done over 6 million trips so far in only 12 months.
Now it's been said that this business could be more profitable than a ride-sharing business because you don't have to pay drivers. Is that a fair assessment? It's hard to believe that you could make more monies renting bikes and scooters than Uber can make sharing cars.
Well, we don't know about the Uber's economics, but apparently, taking, not paying the drivers and cars is a big, cost reduction for us, right? But I think more importantly, we're solving a higher frequency use case, which is, shorter distance. That's part of most of the transportation needs on the everyday basis. So I think that's a big, foundation of our potential, market.
Now, there are challenges in every city, and every city is unique. Yep. And in San Francisco, there's a freeze on scooters right now. People were not happy with the scooters getting left around, and now they're going to be doing a trial program where they're going to pick 5 companies that can have it out. And you're applying for that right now. Yep. What's going to make it different this time around? Like, what can you promise the city and the residents who got pretty annoyed?
So we hear the feedback, and then we actually one thing that differentiates us from the other players is that we take city relationship very seriously. Before we launch, before we go into any markets, we talk to the city officials. Sometimes the MTA or Department of Transportation, and we hear the feedback from operating about 10 to 12 weeks in the past, and we're implementing a lot of exciting features. For example, after each ride, we ask the riders to take a picture about their parking so that people are held more accountable to that. Also, we're hiring locally so that we have a operation team on the ground, making sure things are all in orderly manner.
So you're taking the non-Uber approach to working with cities.
I would say we learn from all of the best practices, no matter it's good or bad, right? So we want to make sure that we do the best for the city.
Lyft also just made an acquisition in this area, and there are several different companies that seem to provide the same thing. What gives you an edge? Like, why isn't this just a commodity?
I think this is exciting time because every players and major players move here just simply says this is a huge market that we need to have more efforts and innovations to help solve the problem, right? We're excited about potential competition and then really working with the cities and then making sure that we're always customer first, right? So not looking too much on the competition, but also more focused on the product, customer, to make sure that we can excel from that.
There's been speculation that you might provide a two-seater electric car. Is there anything to that?
Unfortunately, we can't share too much about that, but I think, again, we're a user-centric company, right? So anything that's, user needing and then not available now, and if that's something that we can do better than anybody else, we will consider. We'll share more once it's available.
So this is a lot of money you're raising. What are the expansion plans?
Yeah, so we have an ambitious goal. So we want to serve more cities and more users, right? So now we're live in more than 70 markets with our bikes and scooters. And by the end of the year, the goal is to enter and serve over 100 markets. And then, of course, we'll keep iterating on the products and also build out a team.
You do bikes, scooters, and e-bikes at the moment.
Yep.
Are they all manufactured in China?
Yes.
So this trade war that's happening, does that impact you?
We're still analyzing the impact, but so far nothing impacting us. And I think the impact could be minimum because the utilization and the business model just worked very well.
All right, Toby Sun, CEO and co-founder of Lime. Thank you so much for stopping by.
Thanks for having me.
I'll be watching the streets too. Thank you. All right, it could be a massive week for media M&A. We'll discuss where things stand as Disney, Comcast, and Fox jockey for power and assets. This is Bloomberg. Samsung Electronics opened the world's largest mobile phone factory in India on Monday. The site, on the outskirts of New Delhi, will produce 120 million smartphone units a year, including flagship products like the Galaxy S9 and Note 8. The facility was inaugurated by Indian Prime Minister Narendra Modi and South Korea's President Moon Jae-in. Last year, India overtook the U.S. to become the world's second largest smartphone market after China. Samsung is the latest name to expand in India following investments by Xiaomi and Oppo. Well, a major week ahead for media. The biggest industry names will gather in Sun Valley, Idaho for the annual Allen & Company conference. And ahead of that, we could finally get the next salvo from Comcast in the bidding war for Fox assets, or a higher bid from Fox as it competes to buy Sky in the UK. Here to discuss, our Bloomberg News media reporter, Jerry Smith. So, Jerry, what is Comcast's next move?
I think that's what everyone's looking for. One of the M&A battles going on right now is between Comcast and Disney over the Fox Entertainment assets. And right now, Disney has the upper hand. It has the higher bid. And I think a lot of people are waiting to see what Comcast is going to do next. Are they going to come back with an even higher bid?
So what do we expect? I mean, does Disney or Comcast have the upper hand here? It seems like James Murdoch and Bob Iger have been pretty chummy.
Yeah, I think that Disney certainly has the upper hand. It has currently the higher bid for the Fox assets. I think a lot of people are expecting Comcast to come back and actually top Disney's bid, and we could have a bidding war that continues on into this summer.
So what does James Murdoch want? Do we know?
Well, James Murdoch is looking to maybe do his own, venture firm, but Rupert really is the guy who's, calling the shots here. And there is a lot of speculation that he would prefer to sell his much of his empire to Disney and not to Comcast. There's a history of bad blood between Rupert Murdoch and Brian Roberts that goes back years. I mean, these are two media moguls that have been duking it out for decades, since really the cable industry was still in its infancy. So, Disney has the higher bid. Certainly, there's also tax considerations. And the Murdochs are we've reported that they would make more money by taking a Disney bid than a Comcast bid because of the tax considerations of a stock deal versus a cash offer. So there's a lot still to play out here. Brian Roberts, the CEO of Comcast, is not easily deterred, and I think a lot of people are expecting him to come back with an even higher offer for the Fox assets.
And the Fox-Sky situation, how does that add a wrinkle here?
Yeah, I mean, it's a little complicated, but, you know, while this whole battle between Disney and Comcast is happening over the Fox assets, there's also a battle between Fox and Comcast over Sky, which is a very well-regarded European pay TV provider. Right now, Comcast actually has the higher bid. They have a deadline of this Friday to formally make their offer to the Sky shareholders. Meanwhile, Fox is, as we've just reported, is lining up financing to potentially top Comcast's bid for Sky.
I do want to ask you about another story. The New York Times obtained a recording of a town hall in which the new AT&T executive that is overseeing HBO was speaking with HBO's Richard Plepler and insisted that HBO needs to make more money and try to scale its quality a la Netflix. Is that possible?
Yeah, I mean, I don't think that AT&T is, you know, they've been pretty open about the fact that they want HBO to make more content. I mean, really, if you think about it, HBO is competing with Netflix. HBO has a streaming service, and one of the really key things about owning a streaming service is you have to have enough content so people don't just watch Game of Thrones and when the season's over, they cancel their HBO service and then re-up it again when the season starts a year later. You have to have a steady diet of really good quality content to keep people on a streaming service. It's different than like a cable company where if you want to cancel cable, it's actually a pain in the neck. So I think AT&T looks at the future, looks at HBO and trying to compete with Netflix and realizing that HBO does a lot of quality, but they also need to increase their quantity as well.
But are they going to have the bottomless budget that Netflix has?
You know, actually AT&T has not said, they've not put a number on how much more money they would like HBO to spend on original content. They just said that they'd like to see them spend more, but we haven't seen the details yet on exactly how much they'd want to spend. Netflix is, you know, has very, very deep pockets. It's hard to imagine that AT&T would be willing to compete at the same level as Netflix. But, you know, HBO for years has been competing with Netflix and has not put out nearly as much content, but still, you know, has seen a lot of growth in their streaming service, has, you know, the amount of Emmys that HBO is winning is not going down. So, you know, this is a company that is, you know, they've always put a premium on quality, and now AT&T's coming in and saying, look, we need you to make more.
Bloomberg's Jerry Smith, thanks so much. We'll be watching. Coming up, literally, Xiaomi's IPO calls the company a new species, different from any other, but are investors buying it? That's next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Let's return now to our top story. Hong Kong's biggest coming out party in 2 years. As Xiaomi makes its public debut, Xiaomi's market value is now in the region of $50 billion, making it the world's third biggest publicly traded smartphone maker. Bloomberg's chief North Asia correspondent Stephen Engel has more from Hong Kong.
Xiaomi shares fell right out of the gates here on its IPO in the Hong Kong Stock Exchange. A lot of uncertainty about this company and its lofty valuation that put it more than Apple, more than Facebook, more than Tencent. Also, the true nature of its business. Is it more of a low-margin handset manufacturer, or is it, like the chairman, Lei Jun, says, a broader internet services company? Oh, and also there's a backdrop of a growing trade war between China and the United States that has dampened sentiment here in Hong Kong. The company says it's a tough one to pigeonhole.
We are actually a new species. We are an internet company that can do e-commerce and hardware well at the same time. I don't think there's anything like us in the market before.
On the one hand, Xiaomi is now a $50 billion company, the third largest in the world for handset manufacturers. But it's a far cry of an earlier estimate last year of a valuation upwards of $100 billion. The size of the IPO also really scaled back down to about $3.1 billion US from an initial estimate or aim of about $10 billion. One dampening prospect was the elimination of a corresponding listing in China, in Shanghai, of a CDR. That's a China Depository Receipt. Even the regulator in China shared similar concerns as investors here in Hong Kong about its lofty valuation and the true nature of its business. Stephen Engel, Bloomberg News, Hong Kong.
And here's more of Stephen Engel's conversation with Xiaomi's CFO, Shouzi Chu, where they discussed how he defines the company and its outlook for U.S.-China relations. Take a listen.
We are actually a new species. We are an internet company that can do e-commerce and hardware well at the same time. I don't think there's anything like us in the market before.
And how are you going to go from getting about 80% of your revenue right now is in hardware and handsets, lower margin handsets. And Lei Jun has spelled out a vision. He wants to build out the ecosystem of services and video, music, and other things. How are you going to, and over what time frame do you see the revenue mix changing?
So internet services for us is first and foremost to provide a better user experience for our users. And then on top of this basis, we have found that it's a very highly monetizable source for us as well. Last year, we were at about 8.6% of our revenue, internet service as a whole. And by the first quarter, this has risen closer to 10%. So the trend is that this is becoming a bigger part of our revenue going forward.
And Lei Jun also said he wants to get eventually more than 50% of revenue from overseas markets, and I would assume not just selling handsets, from services. India, you're doing well, but where would the priority be, and how would you crack the U.S. market?
I think for internet services, the priority for us is always to make sure that the user experience is good. So we are starting to do this internationally, including in India and in Indonesia. And we think that over the course of the next few years, we're going to expand this to other countries that we operate in as well.
How are you being negatively impacted sentiment-wise by the trade war between China and the United States?
We are long-term positive, very optimistic about the relationship between China and the U.S., and we are sure it will be sorted out in time. Right now, we don't have operations in the U.S., so the impact is very minimal.
I know it's a sensitive issue too, but the CDR had to scrap that. Will that be resolved over time, and what time frame are you looking at?
Well, we just got listed here in Hong Kong this morning, so I think anything CDR related, we'll go back and take stock.
Do you consider this maybe was a bad timing listing right now, or was it a matter of you had to list now? I think the last round of financing was in 2014. How critical was this listing for you?
I think the IPO event itself is a very important landmark event for a company's evolution, into a bigger company. And for us, what we need to focus on is the long-term value of what we can deliver. I think short-term fluctuations and timing of the market are things that are important, but not the priority for us.
That was Xiaomi CFO Shouzi Chu speaking with our own North Asia correspondent Stephen Engel in Hong Kong. Turning now to Twitter. The company CFO is trying to dispel concerns that a crackdown on fake users will impact the company's growth. Shares had fallen as much as 10% in Monday trade after a Washington Post report that the rate of Twitter account suspensions has more than doubled. The stock then pared some of its losses after CFO Ned Siegel tweeted, quote, "Some clarifications. Most accounts we remove are not included in our reported metrics as they have not been active on the platform for 30 days or more, or we catch them at sign up and they're never counted." Joining us now to discuss, Bloomberg's Selena Wang. So what exactly is happening here?
What this really amounts to is a delayed overreaction on the part of investors. What the Washington Post is saying really just echoes and confirms what Twitter said themselves just 2 weeks ago. Now, 2 weeks ago, I reported that they're actually tripling the amount of spam and automated accounts that they're identifying. So they're finding about 10 million of these accounts every week. In addition to that, they are stopping more than 50,000 spam signups a day. And as their CFO tweeted today, this is going to have a marginal impact on monthly active users because most of these automated spam accounts are not active every day, every month. And in addition to that, a lot of them are stopped before they even join the platform, so they're not counted toward those metrics.
10 million accounts a week? That's a lot.
What this does bring up, and what should be concerning to investors, is that this great improvement does bring into question just how much of Twitter is actually fake. Is it really just 5% of active user accounts that are fake, as Twitter says, or is it much higher, as independent researchers say, as much as 15%? And why didn't the company do more to stop this earlier? But the actual disclosures of these numbers should be a sigh of relief for investors, not a cause for concern.
So how are they actually purging these accounts? Like, what have they added AI? Is it humans? How are they picking up the pace?
They've created an internal task force ever since they've had escalating concerns and criticism from lawmakers that they didn't do enough to stop manipulation on the platform in light of the 2016 elections. They've also dedicated a vast majority of their engineering resources to solving this problem. They want to be able to stop these malicious accounts before they actually start behaving. They want to catch them at the inception with these algorithms. I actually reported a few years ago, a former employee discovered a huge number of accounts that were dormant from Russia and Ukraine, and that at the time, in 2015, the company did not do anything about those accounts. Now, that shows that Twitter has come a long way since 2015, when they were prioritizing user and revenue growth over spam and automation. Had that same employee came to Twitter today, they definitely would have deleted those immediately.
So how are users responding to this?
I think this is ultimately a positive reaction.
I mean, are
from
any
users.
of the users behind these fake accounts,
or
organizations, or whatever they are?
I've had some tweets from users saying that they're losing a lot of followers as a result of this, but I'm also getting a lot of tweets that this is good. It's about time. In the long run, user growth is going to decline if they continue to allow the toxicity that leads to abuse and harassment to run rampant on the platform. I think a big sign that this is actually a positive move for the company is a statement that I got from Unilever 2 weeks ago when I first reported the new account suspensions. Unilever in February was threatening to pull ads off of all social networks because of the toxicity on them. And after the new disclosures from Twitter, they said, this is great. We're very happy about these increased moves to get rid of the hordes of fake accounts that are running around Twitter.
Now, Twitter stock has been up 70%. Could this dent the turnaround? Will that continue?
I don't think this is going to dent the turnaround. We actually just saw a note from JP Morgan which said this is actually a buying opportunity. There has been a misunderstanding about these disclosures and the impact of what it's going to have on monthly active users. This is a positive sign that Jack Dorsey is working and following through on his vision to increase the health of the platform, and this isn't going to dent the turnaround.
All right, Selena Wang, Bloomberg Tech, who covers Twitter. Thanks so much. Meantime, Alibaba is in talks with BT about a cloud services partnership as the Chinese internet giant challenges Amazon's dominance in Europe. Alibaba already has an existing arrangement with Vodafone Germany, and the terms of the deal will likely be similar. Europe has become key to Alibaba Cloud's success outside of China. The company has pulled back in the U.S. just as trade tensions between America and China have escalated under President Trump. Coming up, tech earnings season is right around the corner. What to expect from Netflix, Alphabet, Facebook, and more next. And later, could this be the end of Groupon as a standalone company? And what tech giants are interested in taking it in? We'll discuss later this hour. This is Bloomberg. Big tech earnings season is right around the corner with Netflix due out July 16th. The company has been on a roll this year, and investors have high hopes that the streaming company will continue its successful performance. To talk Netflix and all other big tech earnings, we are joined by Bloomberg's Romain Bostic, as well as Bloomberg Intelligence's Jitendra Rawal. Romain, I want to start with you on Netflix. It's had a breakthrough year. We just spoke earlier about how AT&T wants HBO to be more like Netflix, but can Netflix's success and this trajectory continue?
Well, I mean, look, they're on this basically, this sort of trajectory of sort of grow at all costs, and investors really are willing to sort of give them a break. I mean, this is kind of the same playbook we saw out of Amazon when it was growing its business, which is just spend, 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 try to gain as much market share as you can, and somewhere down the road, the profits will materialize. And Netflix has produced profits. Of course, the concern is just how much are they going to have to keep spending in order to keep up this trajectory. Now, as long as that subscriber growth is there, I think you'll see investors will be happy enough with it, and they'll continue to push the shares up. You're looking at a stock that's more than doubled so far this year. It's the best performer in the S&P 500, best performer in all the NASDAQ measures, and is really the leader amongst the tech leadership. And I think as long as they can show that they can sustain those subscriber growth numbers, I don't really see anything knocking it down from its perch, at least not in the short term.
Do you, Jitendra? I mean, Amazon has certainly tried at this Prime Video thing, and as a Prime member, I'm constantly reminded that they also have video. They're trying to push this to subscribers, but can they ever grow the bit? We know that there's been a lot of turmoil in the leadership of the Amazon Prime Video business. Can Amazon really give Netflix a run for its money?
You know, the agendas are different over here, right? So Amazon is trying to get more ROI with their content spending, with attracting more Prime members globally, driving more spending on Prime and things like that. So we think they can coexist. The growth can also coexist. But at some point, Amazon could outspend Netflix, because the ROI that they are getting by chasing e-commerce and other services is significantly higher than Netflix. So maybe longer term, but for now, I think they can coexist.
Romain, talk to us about, the broader tech view. We've got a slew of earnings coming up. Tech was on a roll earlier this year. Then there was a ton of volatility. What are you going to be watching for to set some benchmarks as to how the rest of the year will play out?
Yeah, well, one thing that a lot of folks that I have spoken to over the last couple of weeks have mentioned is that the technology shares, the large cap tech, I should say, has really become sort of a safe haven play for a lot of investors who are looking to sort of buffer themselves from some of the political and geopolitical and trade headwinds that have been out there. And they're looking to a lot of these large companies like Amazon, like Apple, as well as some of the other companies like Tesla, Facebook, and others, and basically saying, look, these companies are big enough to withstand some of these issues. They're still growing. They're still in a solid phase where they can produce both cash and profits pretty much at will. And as long as they're willing to do that, more investors are going to be flocking to that. It's one of the most crowded trades you have out there. You look at the positioning among hedge funds and other large investors. This is the place where they're basically looking for safety right now. And unless you get some significant negative or pessimistic outlooks from these companies, I don't think that's going to change.
Well, and Jitendra, Apple has been the one we've always talked about getting to $1 trillion market cap first, but Amazon's actually encroaching there.
Yeah. And actually, if you, to the point you made about the end market growth, if you just look at this earnings that's going to come up and this year in general, mobile ad demand is very, very strong. 20% plus growth in the industry. So what you're going to end up seeing is Google, Facebook, continue to benefit from that tailwind that they have from the industry. And likes of Amazon, you see surprises coming from the advertising department, which is becoming a more significant profit driver going forward. So basically, the secular tailwind is behind these companies. Now, one thing that investors will watch out for closely is, the impact of GDPR and the compliance costs that have gone up for these companies, and if that shows up in their margins by some way, shape, or form, and all these steps that the ecosystem has really taken to improve data privacy issues, information issues, and things like that. If that could sort of move the needle on the profit side or pressure that, but if you look at the end market, the revenue growth should be fine.
Meantime, Romain, you've got folks like BlackRock out there saying tech isn't as overvalued as it looks. What's the sort of consensus about whether these buys are worth it?
Yeah, I mean, there's sort of two camps. You have some folks who look at the PE ratios. You talk about Netflix. I mean, they've got a PE ratio, I think, of around 260. Amazon's is over 270. But BlackRock's Russ Kosten did put out a note recently basically pointing out that these companies, if you look at them in the right way, really aren't as overvalued as you would think. And we have a chart that I think we can pull up that sort of illustrates this point. I mean, he's taking a look at the PE ratios and also how they relate to sort of the PE ratio ratio for the S&P 500 as a whole. And what you're looking at on that screen here, that's showing you the gap between the PE ratios for the S&P 500 tech stocks versus the S&P 500 as a whole. And what is basically showing you that it's well below the historical averages, well below where we were back during the sort of the tail end of the tech bubble. Basically, his argument is that these stocks really aren't as overvalued. He thinks that they're still a buy, primarily because the growth story there is much, much stronger than what you're seeing from the non-tech side of this market.
Now, Jitendra, got to ask about Facebook. You know, last quarter, we really didn't see much of a dent from all of the controversy and the data scandals. Will we see that this quarter?
It's difficult because Instagram is the savior here. So you're going to see Instagram revenues growing much rapidly. In fact, if you subtract Instagram from Facebook's core revenues, it might be slowing. But Instagram is sort of like carrying the ball forward over here for Facebook. And because the end market demand is strong, I think the revenue side is going to be fine. It's just the cost side, which it didn't surprise last quarter, but investors will still look at it, like in terms of like all these regulations and investments that they're doing. Is that changing the trajectory at all? But I don't think Facebook should surprise on the downside on the revenue.
For the core Facebook service, though, will we see a dent in earnings? Will we see a dent in user engagement?
The time spent, the engagement, the revenue growth is slowing, but on an absolute basis, it's still very, very strong. You know, so because of that, I don't think you would see that dent yet. But longer term, I think the plan over here is bank more on Instagram while holding the fort with Facebook.
All right, Bloomberg Intelligence's Jitendra Rawal, as well as Bloomberg's Romain Bostic. Thank you both. We'll be watching. Coming up, Groupon could be waving the white flag as an independent company. Which tech giant might swoop in and purchase the voucher vendor? We will discuss next. This is Bloomberg. After 10 years of running as an independent company, Groupon could be looking for a buyer. Reports say the merchandise and voucher vendor has approached several public companies in recent weeks to try to drum up interest in a sale. Investors have long expected an acquirer to swoop in and have cited companies like Alphabet, Facebook, Apple, and Amazon as potential buyers. Joining us now, Bloomberg Tech's Sarah McBride. Also with us on the phone, we have Tom Forte, analyst at D.A. Davidson, who currently has a buy rating on the company. And Tom, I believe you are the biggest Groupon bull out there. What's your take on this?
Sure. So my take is that there's a dislocation when you look at the valuation of Groupon as a public company. The North American business is in the best state it's been in its history, and they have international operations well positioned for future growth. So on that basis, with this disconnect, I'm not surprised that management would consider selling the business as one way to generate more shareholder value than they're getting today.
Sarah, who could the buyers be?
A lot of people to think about. So one could be Qurate, the company that owns QVC, the John Malone company. Another one could be Alibaba. They already own a stake in Groupon. You could also think about IAC, whose CEO is on the board of Groupon. So there are a lot of companies, in addition to the ones you named, that could be circling around this company.
What about Amazon, Tom? I mean, Amazon's been making a lot of big buys. Is this something they'd want?
So Amazon's kind of a special case. If you look at their historical M&A strategy, it's been build first and buy second. And some time ago, they had Amazon daily deals, and they still have daily deals, but it's more about getting merchandise at a discount. So I don't know that for Amazon, there's a lot of incremental value to the extent that I don't know that Amazon wants to do more in the local merchant arena. To me, the companies that make the most sense are a Google or a Facebook, companies that would leverage those relationships with those local merchants of Groupon and then overlay or sell incrementally more advertising to them. So I don't see Amazon as really as a suitor for Groupon.
It's interesting, Sarah, to think about the history of Groupon. This is a company that Google almost bought for $6 billion, and now the market cap is $2.6 billion. Right. It just didn't deliver. You know, there were thoughts it could be a $25 billion company.
Yeah, that's right. Their CEO now actually came out of Amazon, so it's interesting to think about the relationship between those two companies. And he has put in place a lot of changes that make people interested now. For example, they have Groupon Plus, which allows customers to link their credit cards to their Groupon accounts. They have a better app. So the customers they have now are a lot stickier, visit the site more often, but that hasn't translated yet into revenue growth for the company.
And how important is it, if a sale happens, to maintain that local feel? I mean, really, isn't that the secret to coupons?
Yeah, that's the strength of the whole company. It's what makes them an attractive target.
Tom, what do you think's going to happen?
Ultimately, I think that they'll sell the business to an acquirer, in one who would be able to leverage those merchant relationships. I just really feel like they're doing a lot to strengthen the value of the Groupon platform. If you think about what they're doing with full price sales, you can go to Groupon and buy Major League Baseball tickets both at a discount and full price. And then you mentioned Groupon Plus earlier. That makes the service easier to use. So when you think about this stronger, healthier Groupon today, if the market doesn't value it properly, I think for one of these businesses, it's a great opportunity for them to add Groupon.
All right, Tom Forte, analyst at D.A. Davidson, along with Bloomberg Tech's Sarah McBride. And if you're planning to be out in the sun, you will need some SPF. And it's no different for NASA's newest probe that is getting the best solar protection possible. NASA's Parker Solar Probe has been given an ultra heat shield to keep it from burning up, as it will attempt to get closer to the sun than any other vehicle before it. Temperatures on the shield will reach nearly 2,500 degrees Fahrenheit as Parker approaches 4 million miles from the sun's fiery surface. The shield will help keep the probe cool at 85 degrees. NASA's engineers installed the protective shield in late June ahead of an August launch, and they are hoping to make new discoveries about how heat from the sun affects life here on Earth. And that does it for this edition of Bloomberg Technology. From San Francisco, I'm Emily Chang. This is Bloomberg.